Statement of Cash Flows, presented by Ed Phillips from Eisner-Amper and sponsored by Credit to Be. I do want you to feel free to ask questions along the way just by typing them into the chat box on the dashboard. We will try to get to the questions at the end of the webinar. If we are not able to get to all the questions, we will be emailing everyone with the presentation along with responses to any questions that you may have that we weren't able to get to. So today's presentation is on statement of cash flows. So we'll be talking about different uses of cash and the full cash flow statement. Just a moment about Credit to Be before we get started. So Credit to Be, we have a mission to provide timely, relevant information about all of the customers that we're doing business with. We combine trusted credit information from your trusted connections along with credit bureau information and expert credit analysis from Credit to Be analysts. Credit to Be can help you by creating connections based on your trade file of customers. We will give you information about overlaps within the Credit to Be portfolio or Credit to Be platform with other members and networks that may be doing business with your customers. You then can access other peers doing business with your customers to get additional information and insight into your customers, along with credit bureau information and expert advice and research from the Credit to Be analysts. So we pull all of that information together for you to help you come up with an informed credit decision and then to monitor that decision going forward on that customer. With that, I want to introduce Ed Phillips. He is a partner with Eisner-Amper's bankruptcy and restructuring practice. He's involved in all aspects of the restructuring field, including troubled company turnarounds, creditor committee representation, and more. So with that, I'll introduce Ed.
Okay. Good afternoon, everybody. We're going to take you through the statement of cash flows today, and we're going to start with just a quick review. I think everybody knows financial statements are made up of three documents: the balance sheet, the income statement, the statement of cash flows. The balance sheet is really a presentation of a company's resources and obligations. It's the classic formula: assets equal liabilities plus capital. What's supporting your assets? The income statement is the performance of a company over a specific period of time. Revenues less expenses equal profit or loss. Income statements are typically prepared on the accrual basis of accounting, and they record transactions when they occur, not when cash changes hands. So what happens with that is that it brings us to the cash flow statement. And what a cash flow statement does is that it bridges, it acts as a bridge that reconciles the company's accrual income or loss with its change in cash over a measurement period. So by definition, the statement of cash flows excludes non-cash transactions in a somewhat convoluted manner. It's a financial statement that shows a fairly complex computation of net income combined with changes in accounts on the balance sheet that affect cash. One thing it'll do, it'll tell you how a company gets and uses its cash. You can use it as a tool to compare similar companies because it strips away the use of accounting estimates. One of the things that affects, a couple of things that affect net income are how a company depreciates its capital assets. The other issue is the use of estimates. Accrual financial statements are loaded with management estimates. So what this does is it strips them away and lets you get down to the cash. You really can't fake cash. When you're reading a statement of cash flows, you need to read it in conjunction with the other financial statements and the notes. And always remember, like other financial statements, It's reporting historical activity and doesn't project into the future. And the most important thing to remember when we're done with this is that net income does not necessarily equal cash flow. Okay. Okay. Next thing I want to cover is what the major sources and uses of cash are for most businesses. Your sources, where you get your money from, tend to be, not in any particular order, disposal of capital assets, disposal of long-term investments, issuance of long-term loans or bonds, borrowing from the bank, selling stock, and hopefully operations. Hopefully operations is a major generator of cash for the businesses that you're analyzing. Okay. When businesses generate cash, there are only so many things you can do with cash. You can invest it back into the business by purchasing more capital assets. You can purchase long-term investments. You can buy other businesses. You can repay your long-term debt. You can pay dividends. You can repurchase stock. Some companies over the past several years have turned to another option. They've just let cash pile up on their balance sheets. Okay. Statement of cash flows is broken down into three major segments. The cash provided or used by operating activities, the cash provided or used by investing activities, and the cash provided or used by financing activities. Now there are two presentation formats, direct and indirect. And what this is going to focus on is the indirect method, because chances are almost every financial statement you will see is prepared on the indirect method. It's what GAAP requires. I know there's talk about IFRS, the international standard, and I'll point out probably the major difference between a GAAP financial statement and if you come across an IFRS financial statement is that on repayments of loans, the interest, on repayment of loans on a GAAP financial statement, the interest is sitting in operations, and the repayment of loans is sitting in the financing section as a use of cash. With IFRS, it's all of a loan payment, interest and principal, is sitting in the financing section. And my lame attempt at accounting humor is that because we're in America, we still use pounds and inches, so we also still use GAAP. Okay, I wanted to show you what a whole cash flow statement looks like, but it takes up way too much of the page, so we're going to flip to the next page. And what I did was I took this, I took the cash flow statement of a chemical manufacturer. It's a small public company in Illinois that I'm familiar with, and I figured I wouldn't step on anybody's toes with this group by using this company. And what I did was I just condensed down their cash flow statement. Just to the three main segments and then the remainder of it. So for financial statement presentation purposes, you're going to get 3 years of cash flows for a public company. So you can look across and you can see that their operations were producing positive cash flow for the 3 years. They spent money on investing activities, and it bounced around a little on the financing activities, and you can see their cash really didn't move too much year to year. They obviously had plans for what to do with all of the cash that the business was generating. Just another point you'll see on pretty much every cash flow statement, there's a supplemental disclosure, the cash that was paid for income taxes during the year and cash payments for interest. You'll see that practically on every financial statement. So what happens is that for operating activities, the computation brings to a single number the cash generated from the sales of the company's goods and services, less whatever cash was required to produce whatever it is that the business was selling. So what's in that number is all the cash sales and collections from customers throughout the year, and then all the payments for all the things that go into the business, depending on the business: inventory, shipping, supplies, salaries, wages, taxes, utilities, and other expenses that a business is going to incur to carry out its day-to-day operations. What's not in cash flow from operations are sales on credit where the receivable is still outstanding, expenses incurred but not paid for, essentially your accounts payable and your accrued expenses, acquisitions and sales of assets, equipment, businesses, those are investing activities, and transactions related to equity, borrowing, and lending transactions. Okay, this is probably, of the three sections, this is the one section that should almost always be producing positive cash flow. It's really why a company is in business, to generate cash from its operations. Okay. There's one exception for healthy companies, and that would be a small, rapidly growing company. And that's because when you're rapidly increasing your sales, your operations are going to consume all of your cash flow. Your receivables are rising. That's the use of cash. As your receivables grow, if you haven't collected it, you don't have it to spend. You may have to be increasing your inventory rapidly. If you have to pay for that inventory, it's going to be a use of cash. Somewhere, somehow, you're going to have to finance that growth. So what happens is that you need increased working capital. A lot of companies will finance their receivables and higher inventories. Most of the time, that's going to involve the use of other people's money. Either they're going to stretch out payables, or they're going to take out financing facilities or raise capital. Those are not operational sources. And sometimes you'll see a declining business that generates positive operational cash flow. And what happens in a declining business to do that? They're liquidating their assets, primarily the current assets, such as collecting out their receivables and liquidating their inventories to fund their operations. And the next little section, you can kind of look at it as a box. If a company's operating activities are using cash, it only comes from one of four places. Either they're depleting their cash, they're borrowing money, selling off assets, or raising new equity. You really, I think I said it earlier, you know, cash is the one thing you can't fake. It has to come from somewhere. So we're going to go through the computation of operating cash flow. And what happens is you start with your net income, and then you add back non-cash expenses, and working capital accounts are the differences in working capital accounts are adjusted. And I'd point out one thing. When you're trending out companies that you're analyzing, you want to watch for a widening gap between reported net income and cash flow from operating activities. You might run into a situation where somebody is speeding up their revenue recognition, or they've slowed down their expense recognition. So they're reporting higher income. They're reporting higher income, but their cash flow isn't going up in proportion. Just something to be on the lookout for. So as I said, you're going to start with net income, and then you're going to add back the items that affect the income statement, but they don't involve cash. And the common items are depreciation and amortization. When assets were acquired, they were accounted for in investing activities. Depreciation, as everybody knows, everybody calls it. It's a non-cash expense. You hear about that all the time. And they don't involve current cash outlays, but essentially it's a write-down of an asset that was acquired and paid for in the past. Okay. Gains and losses recognized on asset sales and any unrealized gains and losses that might have been booked. Okay. The gain or loss is the proceeds less what you paid for that asset. Okay. The proceeds are accounted for under investing activities. So yeah, You either subtract out the gain or you add back the loss that was recognized. Impairment losses, and I know we've talked about this in the past if you were on for the talk on either the notes or goodwill. An impairment loss is really the revaluation of a prior investment. So when that investment was booked, there was no effect on income. It was just a use of cash, or money was borrowed or invested into the business to pay for it. Sat on the books as an asset, and nothing was done with it. When the impairment loss is taken, it's a hit to the income statement, but it doesn't really affect cash that year. The cash had already been spent in the past. Another thing you'll see, especially on public companies, stock-based compensation. It's not paid in cash. Essentially, it's a dilution of current stockholders by giving the equity or paying equity in the company to employees. So you'll see stock-based compensation added back. Deferred compensation is another item, and a lot of times these have to do with executive compensation plans where the expense is booked, a long-term liability is booked, and it'll be years before it's paid out, but it's still a real liability of the company. Okay. And then there are also provisions that are booked into current assets and other charges. Allowance for doubtful accounts. What that does is it reduces the net accounts receivable on the books. Doesn't cost you any cash. You haven't collected the cash yet in the first place. Inventory write-down, same thing. Material restructuring charges. You read about companies all the time taking large restructuring charges. They take a hit to income in 1 year, and the expenses they incur may not get paid out until a period of time has passed. A lot of times when companies restructure, they realize they're going to incur severance obligations, obligations involved with closing of facilities. So they calculate what that is, but it sits on the books as a liability until the cash is actually paid out. And one of my least favorites, the booking and impairment of deferred tax assets. Okay. After that, you have changes to the working capital accounts that are factored into the calculation. So increases to current assets, such as the two most obvious, receivables and inventory, they consume cash. Conversely, decreases to current assets are going to produce cash. On the other side of it, increases to current liabilities, and I think the things you think of the most are accounts payable and accrued expenses. The longer you take to pay your payables, or the more you're increasing your payables, the cash is still sitting on your books. Again, if you're paying down your payables, you're using cash. So just very quickly, I'll run through some of the common adjustments you'll see on a cash flow statement. You'll almost always see, if a company has receivables, you're going to see adjustments to receivables, inventory, accounts payable. Accrued expenses sometimes are separately broken out. Sometimes they're combined with accounts payable. Currently payable income taxes, deferred revenues. You see deferred revenues with companies that sell a product or service where a long-term obligation comes with it. One of the easiest things is software, where a company will have a continuing obligation to provide updates for their software over a period of years. So what happens is you make the sale in year one, the cash comes in, but you don't book all of the sales because there's expense associated with delivering on that obligation when you originally sold the software. So deferred revenues are booked. Pension liabilities, and then the catch-all, other assets and liabilities. One of the other things you're going to see are the payments that are made on one-time accruals, such as restructuring or environmental charges. So these are almost, the payment piece is always a use of cash. And then there's something you'll see on some public companies in the operating section. You'll see reduction for excess tax benefit from stock-based compensation, and that's added back into the financing section. And you might wonder, why would it come out of one section of the statement of cash flows and go back in on the other? And it's really a quirk. Companies that provide stock-based incentive compensation are able to deduct the difference between the exercise price of the award and the price that the award was originally granted at, because the employee has to pick that up in their income. So they get the deduction on their tax return, but for accounting purposes, it's not really an expense to the company, that difference. So it's a permanent difference. There's nothing in deferred taxes. It's just kind of the way the accounting world looks at it. It's kind of a bonus write-off on your taxes. Real quickly, on the next page, we have just the section for step-in companies operating cash flows. And what you can see going top to bottom, and I'll focus on 2013, they have net income of about $72 million, but their operating activities generated $150 million worth of cash. And if you take a look, the single largest item accounting really for 2/3 of that is the depreciation add back. And I think it looks, in a vacuum, that looks great. It looks like they're throwing off a ton of cash. Other big items, as the business grows, their accounts payable is growing, and you can see right across the board roughly $26 million a year in growth of their accounts payable and accrued expenses. You'll see the deferred compensation number. If you get really bored one night and you download their 10K, you can take a look at their deferred comp plan. It's stuffed with a lot of back-end awards for the current management. If you see something else on there that you'd like to ask about, I'd encourage you to send your question in, and we can deal with it at the end of the presentation. But what I want to do now is move on to the section on investing activities. Okay? This section, unless a business is selling itself off, usually this section you're going to see pretty consistently significant use of cash. Okay? And the amounts in this section, again, are not generated by operational transactions. The biggest item you'll see, purchases of goods, property, plant, and equipment, what we typically call CapEx. Investments, if a company's investing in marketable securities, buying pieces of other businesses, buying businesses, divisions, subsidiaries, entire companies. One thing you'll notice on the operation, and I'll just turn back to the operational section, it only deals with the changes in the accounts attributable to the existing operations. If you look at the financial statements for a company that has purchased a business during the year, the cost of the business, usually net of cash purchase, will show up as an investing activity, and then in the notes of the financial statements, they will tell you how they broke that down. So the math might not always work perfectly if you're trying to figure out, if you look at the balance sheet year to year and the receivables were, X in year one and Y in year two, and you can't understand why on the in the operations section the change in receivables was not Y less X. And it's because other things will end up in that final balance sheet number. So when a company buys another company, they break out the assets and assign it to the proper classifications. Okay. Where you'll see cash produced from investing activities, disposals of capital goods, sales and maturities of marketable securities. If a company owns bonds of another company, the bonds mature, the money comes back in, it's a source of cash. And again, divestitures of businesses. Okay. So I think it's always good to keep in mind companies can do, a number of things to take their cash profits and convert it into other things. So this is the investing section of Stepan's cash flow statement. Now, we had about $56 million in depreciation and amortization for 2013, but we have $93 million of new CapEx, and they purchased a business for $68 million. I think the one thing I would say here is that if you're looking at a business that purports to be growing, and this is one of the reasons I'm not a big fan of the acronym EBITDA, earnings before interest, taxes, depreciation, and amortization. The one thing it doesn't tell you is what's the subject company doing with capital expenditures. And for most businesses that are healthy and growing, CapEx is usually higher than the annual depreciation charge because they're always reinvesting in the business. So when somebody says to you, my EBITDA is this, you have to ignore depreciation, you can't ignore it because businesses are always reinvesting in themselves, and usually if they aren't reinvesting in themselves, they probably aren't growing. Okay. I'm going to move on to the financing activities. Okay. This is the section where companies raise cash that's not raised by operations, pay down debt, and return their cash to shareholders. So when companies borrow money, either on a credit line or a term loan, you'll see it show up in the financing section. You'll see the repayments on those loans show up in the financing section. If they issue common or preferred stock and cash comes in the door, you'll see that here. You'll see the excess tax benefit from the equity-related compensation get added back in here. The big uses, aside from repayment of loans, repurchase of company stock, and if you're an investor, one of the things that's important potentially is the payment of cash dividends. Okay. Negative number in the financing section usually means that a company is either reducing debt, returning cash to shareholders, maybe both. Positive number usually points to either an increasing debt load or potential dilution of existing security holders by issuing more stock. So we can take a look now at Stepan's cash flows from financing activities. And if you recall, they had about $150 million from cash from their operations come in the door. They had significant CapEx, and they also acquired a business. So the question always is, where'd the money come from? And what you'll see is a $100 million term loan that ostensibly covered the business acquisition and then some. And you'll also see what they did with the rest of their cash. Other debt repayments, dividends, they repurchased some stock. Some money came in because employees exercised stock options, and you get down to the end of it, and net $76 million came in from their financing activities. Okay. After the three main sections, one thing you'll see now, the accounting rules changed about 10 years ago on this. You'll see the effect of the exchange rates on cash for companies with international operations. Everything is always converted back into the functional currency of the company. So if they have significant investments overseas, the cash balances fluctuate with the exchange rate fluctuations. The other piece you'll see, and usually it'll be in a breakout for each section, if a company has discontinued operations, you'll see it as a net number sitting with either operations, investing, or financing. But when you add up the totals, for all three sections in the foreign exchange, what you'll come to is either the increase or decrease in cash and cash equivalents throughout the year. You combine that with the beginning cash, and then what you end up with is the ending cash and cash equivalents. And I'm telling you that there's no way to fudge the number. The number has to work. You know, again, it comes back to cash is not an estimate. You really can't fake it. So the very end of the income statement, or I'm sorry, the cash flow statement, looks like what's up on your screen now, the effect of the exchange rates, the increase or decrease, and the supplemental disclosures. And then in the notes of the financial statement, there's usually a disclosure on non-cash financing activities. Some of this stuff is a little arcane. It makes my eyes glaze over. But if you're trying to put together, if you're trying essentially to reconcile the balance sheet, the income statement, and the cash flow statement, it helps to have this information. This note discusses how employees tendered certain of their shares in conjunction with with stock option exercises, and what typically happens is somebody's awarded 1,000 shares. They'll sell off 1/3 of them immediately so they can pay, so they have the cash available to pay the taxes. Another disclosure on this was that at the end of the year, they owed money that was sitting in accounts payable for acquisitions of fixed assets. So it's disclosed here, and it can help the user in that reconciliation exercise. So as I said before, cash flow at the end of the day has to pay out perfectly. You can't make up an estimate to make it reconcile. I will tell you, when you're analyzing a larger company, unless you have an incredible attention span and incredible attention to detail, you might have some difficulty tying it out. When you're analyzing smaller companies that don't have a lot of, not only in terms of volume, but also sophisticated transactions, the numbers actually will fit together fairly easily. And the one thing I would caution anybody when you're analyzing financial statements is, please always read the notes. As I've said before, so much good information is buried in the notes that you just can't surface by looking at the main financial statements. So with that, I'm pretty much at the end of my presentation. I'd be happy to take questions if there are any.
Hey Ed, this is Bonnie Garrity from Credit to Be. Many times our clients are getting financial statements from smaller private companies where they just may get the balance sheet and the income statement. Is there a standard format that you would recommend, or perhaps like a cheat sheet to come up with your own cash flow statement in situations like that?
I could put that to, I have one. I could clean it up and I could get it to you and you could distribute it. But the one thing I would caution is it might not capture everything perfectly. But if you're analyzing a smaller company, what you want to do is you want to start with the net income. You're going to add back depreciation and any other non-cash expenses. And then you're going to take the main balance sheet accounts, inventory, receivables, payables, accrued expenses, those kinds of things. And for increases in current assets and decreases in current liabilities, those are going to be negatives. And vice versa, decreases in receivables and inventory, increases in payables, those are going to add back cash for operations. But you have to be careful, because what it won't catch is if somebody, unless you have notes to the financial statements, and I can tell you if you have notes, you're going to end up with a cash flow statement. But if a company was retiring assets during the year, and if their fixed assets are presented gross, so you can see the cost of the asset and the accumulated depreciation. You should be able to back into capital expenditures purchases. And the other piece of it is on the financing, you might end up with a net number as opposed to cash received from new loans taken out and then cash utilized to repay loans. But if the balance sheet is broken out enough, you should be able to back into most of it. And again, don't get suckered into we're throwing off a ton of cash. You have to add back the depreciation because good businesses are always reinvesting, and if it's a growing business, the CapEx is usually larger than the depreciation expense. Are there any other questions?
Yeah, one other thing I just want to clarify. I mean, you've talked a lot about the CapEx and perhaps comparing that to the EBITDA. What do you feel is the most, or are there, the top 2 or 3 most important things to look for in the statement of cash flow? Is it the CapEx? I mean, is that one that you would be talking?
Well,
bring up?
Well, that's one. I think what you're looking for. You're looking for on a good day. You're looking for positive cash being thrown off by operations. Mm-hmm. You want to have a little bit of concern if you see a lot of new debt going on the books. You have to have some comfort that the operations can generate enough cash to repay the loan and service the debt, paying the interest. So you have to be aware of these things. If somebody's made a large acquisition, what you're hoping for is that the acquisition is going to be accretive to earnings. They didn't overpay for the acquisition, and that the additional cash flow generated by that acquisition will be able to either hopefully service the debt that was taken out, or if it's a really healthy company, you're probably not looking at their financials that closely anyway because they just wrote a check for the acquisition. But usually because equity doesn't get the same treatment for tax purposes as debt, and since interest rates are so low, the companies that can afford to are using a lot of debt right now for acquisitions, and arguably it makes sense. But I would also look again for if there's a large variation in the proportion of net income to operating cash flow, or really it's probably operating cash flow to net income, since usually the operating cash flow is going to be a little bit higher given depreciation will usually dwarf everything else in that section of the cash flow statement. You want to make sure that the proportion isn't straying too heavily one direction or the other, because that's an indicator that there are potentially changes in the business that you have to investigate further.
Right.
And again, the changes would be somebody's messing with the accounting, they're booking the sales early, recognizing expenses late, or things are declining, and what they're doing is they're liquidating their receivables and inventory to generate cash.
Okay, well, thank you for that, Ed. If there's no further questions, I'm not seeing any further questions coming up on the chat. If anyone thinks of anything, of course, after today's presentation, certainly feel free to direct them to Ed, or you can certainly email Credit2B as well, support@Credit2B. I want to thank Ed again for the presentation today on Statement of Cash Flows. When you do close out of the webinar, you will be presented with a survey. Please take 30 seconds to fill that out. It helps us really get some insight on ways to improve our webinars going forward. So I thank you again for participating, and this will conclude the webinar.